Hi everyone, I'm Adrian Johnson from Permanent Wealth Partners. Thanks for joining us for this brief discussion today about pensions. A brief discussion of a very big topic, and my colleague Adam and I are going to have a bit of a backwards and forwards and try and unravel this a bit for you. So Adam, I've used the word big in relation to pensions. Talk to us about that.
Big. So value, I read this in the FT yesterday. The estimated value that is locked up in the UK in pension assets, £3 trillion. That's with a T, £3 trillion. Now, to give you some context, the entire value of the UK stock market, so the value of every company that's listed on the UK stock market, is £3.9 trillion. The entire value of all property in the UK is £8 trillion. So yes, higher. But just to give you some context on the value that is tied up in pensions at the moment, it's up there with the value of every single company based in the UK. It's enormous.
Okay, so that's the big part. But one of the other things that is worth impressing on people is how important pensions are, because often it's easy for the newspapers to quote big numbers and things like that, but as individuals, as everyday people who sort of might get a statement once a year that gets thrown into the bottom drawer, why is that perhaps not the best course of action, and why are pensions so important?
Well, now you think that how we talked about how big they are in terms of when you think about the individual, and let's double click down into each individual person. For most people, their pension is going to be the second largest asset they will ever own in their life. So think about that. The largest asset they purchase will be the property. The pension, most likely the total value locked up in the pension, will be the second largest asset. And how much consideration do you think goes into that pension versus what goes into not only, all right, yes, the property purchase, but the car purchase, the phone purchase, the clothes purchase, the shoes purchase? The research and thinking that goes into those are way more for most people than the pensions. So it's an enormous asset for a lot of people.
And I guess understanding what a pension serves for people in terms of the importance. Clearly, this is your lifestyle in retirement. And these days, retirement isn't like 5 or 10 years as perhaps it was generations ago. These days, you could be retiring at 60, 65 and living for 30, 35 years. So this is your income for those years. This is your lifestyle for those years. So clearly, it's important in a present sense context, but also I have this saying about negotiating with your future self. It's very important to think of these things now, because your future self will really appreciate that you have. Talk to us a bit about the complications around pensions. I think this is an area where people they hear the word pension, they think I must do something about that, and then they pick up the form or whatever the communication is from their provider or their employer who's paying some money into their pension potentially, and all of a sudden it gets very hard very quickly. Talk a bit about the complications around the whole idea of a pension for us.
Sure. No, and it's a great question, because pensions, unfortunately, what people define as pensions, I think in most people's minds are, that's kind of stuck in the 1980s definition of pension, which was the old final salary scheme. And this was where you didn't need to worry about anything. You worked for a company, they accrued, they put some money away every year, and effectively then when you retired, they said, okay, we're going to pay you X for forever until you die, and we'll, if you die before your spouse, you'll pay your spouse half for something like that. For most people's minds, that's when they think of pension, that's their definition. The problem is that has become now, and we'll talk about this, I think, next, is the idea of that responsibility has moved on to the individual. So now your pension, it's far more likely that your pension is what's called a defined contribution pension, which effectively is a pool of money that is invested for you. And you have to make those decisions around the investments. So in terms of complications, what do you need to know? Well, you need to know where the funds are invested. What's the money doing? You need to know about the charges. what are the underlying charges. You need to know about how much your employer is putting into the pension and how much are you putting into the pension, and is that the right thing. You need to think about the asset allocation mix of the funds, and are you in like 100% equity funds, or are you in, you know, so-called defensive funds full of bonds and cash, because they're going to have very different performance attributes. And this is even before I've got to the part about decisions around taking the pensions. So there are a lot of decisions that need to be made around modern pensions, and unfortunately most people just tend to ignore it.
Okay. Now this seems to me anyway been something that perhaps, as you said, started out relatively simple in the defined benefit world or the final salary world where your employer took care of it, but there's been a series of changes coming down the line that have, as you say, shifted responsibility. Do you want to give us a bit of flavour of what this sort of changing, ever-changing landscape around pensions is?
Sure. So I think you've hit the nail on the head there with the idea of the shifting responsibility. So now it is more and more on the individual responsibility, as opposed to outsourcing it to their employer, or even sometimes to even the state. So, and we've seen, and this is also a trend, that actually this shifting of responsibility to the individual is actually, it's not slowing down. In fact, it's accelerating. So not only, for example, have we seen, as we've talked about, the big shift from the kind of classic final salary gold-plated scheme along to the more defined contribution, which is the pot of money that's your responsibility and is invested. We've seen that come, you know, and that's been a trend over 20, 30, 40 years. In the last, let's say, 7 or 8 years, we saw pension freedoms that came in 2015, which gives the individual much more choice in terms of when they actually take the pension and how they take the pension. And frankly, they can take the pension however they like, but there are tax implications on how they do that. And what's the best thing to do there? Again, another good question, and up to the individual. And even more so now, now with what's called auto-enrollment, which is the idea that everybody who is an employee who earns over roughly £10,000 a year is automatically given a pension. So you think about the young people of today who are moving from job to job to job. Every time they change jobs, they are given a brand new pension, and it is their responsibility to manage that pension, to look after that pension, and to make sure they know what it's doing, where it is. Because I can see in the future, people who are, you know, 25, 30 years old today, when in 10, 15 years time, they may have up to 10 or 15 different pensions dotted around everywhere. How is anybody meant to manage that properly? So it is just such a, it is like one of those, it is a ball that is going faster and faster, downhill, downhill, downhill. And we need to make sure that we stop it and keep control of it.
Okay. Yes, indeed. And I mean, all of this really feels like it can be summarized by the concept of decisions, where there's a lot, you know, responsibility suddenly on people who are of all walks of life, all citizens in the society. So it's not just people who've studied finance who get, you know, lumped with these decisions to make and these complications to take on board. So you've got a lot of people, as you say, some of them young, who are just being handed something that they have to think about for a long time, because of the nature of a pension is the money's locked away until you're 55 at least, and you know, in terms of retiring, people might be retiring at 60 or 65 these days. There's a lot of talk about retirement age, but and then retiring for 30 years. So this is not something that you sort of you make a whole lot of decisions up front. There's all sorts of things to consider. Do you want to delve into that a little bit for us?
I mean, we talk a lot about decisions, and the opposite of decisions is drift. And when we think about how we get to when we talk to our clients about how we get to their ideal scenario, we talk about it's a journey, and that journey is a curved path, and you're using the benefit of compounding over time. And the way you ride that curved path is by making active decisions constantly, all the time, looking at what's going on, looking at markets, understanding the pensions, all of those things, reviewing your situation, making active decisions the whole time, which is going to allow you to benefit and ride the curve of that compound curve. Because if you think about the opposite scenario, and it's kind of scary scenario to think about, that's drift. And that's by not making active decisions. And that's by, we all know the concept of drift, which is just letting things slide. And again, the idea of something sliding, as things slide further down, they also pick up pace because things get worse and worse and worse, and underperformance happens and charges eat into your performance, and all of those things get worse and worse and worse over time the longer you leave it. So the way that we think about it is that decisions, making active decisions versus drift. And I think that's hopefully really powerful for most people.
Great. You know, and this is anecdotally, I was speaking to a client 3 weeks ago who asked us to review their pensions, came along with he works in the charity sector, you know, nice business to work in, and the best will in the world, they've auto-enrolled him in a pension, and he's in a default fund, which has got somewhere around 60% cash and bonds in it, which means that this is someone who's going to have that money sitting there for the, you know, probably 30 years, maybe a little bit less, maybe 25, but going to miss out on 4 or 5, you know, maybe let's just say 4% of compounding over 25 years, an enormous amount of money just lost into the ether in effect, and a huge lifestyle impact. And luckily we picked that up and we're able to say to them, look, if nothing else, you need to take on a bit more risk there. So lots of elements to pensions. They're important, they're big, they're complicated, and they're ever changing. So I guess our advice, our call to action here is for anyone listening, you need to speak to a professional about this. You need to speak to someone and get a handle on it and start making those decisions that will compound over time to get you the best outcome for your finances.
Absolutely. It's making those active decisions that continually have that compounding benefit over time. That's the key.
Excellent. Well, that's our little video today. Thanks everyone for listening. Cheers.
Thanks, Adrian.